Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes driving markets at the moment. Whilst I just let you have a read of our disclaimer, I'll just run through what we're trying to look at this week. An absolutely packed week. Try and get through as many events as we can. If you have any questions, of course, please do write them in the box, and we'll try and answer as many questions as we can as well, or at least during the webinar, or at least at the end, or even if you want to email us, then we can reply to some of your questions. So much going on in markets at the moment, so much to cover. We'll obviously try and drill into the sort of key themes at the moment. I'm sat in the UK at the moment, so of course the sterling crisis is at everybody's minds, and we're just trying to sort of, obviously we'll focus on that, but also look at the wider themes driving markets. So initially we'll go through just how markets are shaping up generally, risk assets, so that's stock markets in the US. We'll look at the DAX as well, which is broken down, and we'll also look at gold and oil, which had quite sort of bearish technical breakdowns at the end of last week. We'll initially start with those markets, then we will check out sterling for sure, what's going on with the pound, and potentially what happens next as well. And we'll look at the technicals on euro sterling. I think cable, so that's sterling versus the dollar, is obviously hit all-time lows, so technically very oversold. We'll just briefly touch on the cable chart, I guess, but euro sterling's interesting with the spike higher earlier this morning, so we'll look at that chart. Then we'll review actually the Fed meeting from last week, let's not forget that, and just look at some of the charts around the FOMC. And we'll also look at the Bank of Japan and their intervention as well last week, let's not forget. And then hopefully wrap up potentially with just a quick look at the S&B, so the Swiss, quite interesting price action in the Swissy, Euro Swissy especially. If we have time, yeah, we'll look at that. So lots to get through for sure. In general, markets are, or sentiment has continued to deteriorate really as markets have tested the lows of the bear market. Really on the surging dollar and then surging US Treasury yields as well. The greenback has posted new highs for the cycle, as we said, against numerous developed market currencies, obviously against sterling, against the Canadian dollar, the Aussie dollar and the Kiwi as well, all cycle highs for the dollar. And of course the DXY spiked higher above 114 earlier this morning. Of course sterling's in crisis mode, all-time lows there, around 103.50, I think, a level disputed really, but we've obviously bounced and now we're sort of above 107. A lot happening overnight with that sort of thinner liquidity really, prices spiking on the dollar, on sterling, and then also on bond yields as well. But the wider theme really is a bit of a broken record really at the moment. You know, markets really reeling or really concerned about this central bank shift that we've obviously seen in the last few months. We've been talking about it for a long time. Their campaign obviously to raise rates, to tackle inflation, really at the expense of growth. And it was really the hawkish Fed decision, of course, on Wednesday, 75 basis points, pretty much as expected, but it was the hawkish nature around the dot plots, which we'll look at. And that's really set the backdrop for this slump in risk assets. And then obviously this currency crisis that we're seeing is added to that sort of very concerned outlook and sentiment. I did want to look at a different chart actually to this, which I'll just show you now. Not really a chart, but the fear and greed index. I wrote about this actually in the daily, one of the dailies last week, CNN fear and greed index. Sort of quite a fun way of looking at what markets are, how markets are feeling. It's kind of has various different indicators you can see here, which it all incorporates into their fear and greed index. You can look at that quite easily. You can see the website name up there, and we're obviously now in extreme fear. I think Friday we were sort of higher up, so not in that sort of category of extreme fear, but now we're sort of certainly below 25 on this index, sort of rough index. Quite a nice way of putting it, and just something to bear in mind really. If we go to the VIX, which is obviously well known for being, if you like, Wall Street's fear gauge, you can see on the daily here we bumped up above 30 now, so we're sort of getting into elevated levels now. You can see going back this year at least sort of a few times where we've been up here for a number of days, obviously sort of April period, an extended period of time, and also of course in March, but above 30 is sort of getting towards much more fearful levels. So worth highlighting those sort of fear measures, if you like, for the market. As I say, it's a broken record now. Central banks hiking, the Fed kicked it off, and then obviously we had that whole sort of flurry of major central banks, the S&B, the UK. We also had Norway, Sweden, South Africa, Indonesia, Philippines, all sorts of central banks hiking. And in turn, obviously, that's led to investors really expecting this quite aggressive pace of rate hikes over the months ahead. And then the current pricing for the major ones, at least the Fed, the ECB, and obviously now the Bank of England, really indicating a minimum of a 75 basis point hike at their next meetings. And that's considered the most likely outcome for those three. And the Bank of England would talk about even higher, potentially even sooner than their next meeting, which is in November. With that capitulation, of course, on the likely course of interest rates, you've seen capitulation in these other markets, really. I want to highlight sort of 2-year Treasury yields. So these are US Treasury bond yields. We normally look at, a lot of people focus on the 10-year US Treasury yield, which is really a proxy for borrowing costs. But the 2-year tracks Fed funds rates, the US Fed funds rate more closely, and that is now at, you can see just one very sharp appreciation. Now we're at 4.3% on the 2-year US Treasury yield. That's breached it for the first time, actually above 4.25%, first time since August 2007. And really the focus is really now, if we look at the 10-year yield, that's at 3.78%, you can see here. And really all the focus is now on whether we hit 4% on that 10-year benchmark. The cycle high obviously previously was around 3.5% there, you can see, and then we've broken sharply higher above that 3.5% level, which was a key focus. And then really we're looking at 4% now. I think we have to go back over 10 years, April 2010, when we were at these levels, really. And that has obviously pushed up the dollar, helped the dollar, as we said, push above 114 actually earlier today, pulled back, but just this break around this 110 level. We've highlighted before that 109.29 on the DXY as sort of resistance, then support, and then major support as we sort of oscillated around there during September, and then it was really bullish consolidation here before this strong push higher. You can see we're overbought actually on the daily, we're overbought on the weekly. That can obviously carry on for some weeks actually, and then also on the monthly now we're overbought. And you can see the last time we did that, really at these levels on the RSI was back in 2015, but then we sort of oscillated around that level, even though we pulled back. So just something to bear in mind. RSI, obviously 81, as I said, that can continue. The overbought levels, the oversold, overbought levels can continue for some time, but it's worth bearing in mind where we are with that. For risk markets then, we're really starting to see more stress in some of those markets. And you can see this chart here. So this highlights S&P, the S&P 500 in the light blue line, and then the NASDAQ composite they've used actually here on the orange. But you can see 30% of S&P 500 members, that's the blue line again, and 24% of NASDAQ members are now trading at 52-week lows. And beyond the June peak for the latter, but not the former. So just sort of highlighting stress in the markets now in these risk assets in the S&P, in the NASDAQ, are just really something to highlight. Also then, just to sort of kick markets when they're down, you had a major investment bank, obviously Goldman Sachs, revising their call for their year-end call actually to go to 3,600 for their year-end call from 4,300 for the S&P. You can see there's sort of different scenarios here. So if the Fed manages to sort of procure a soft landing, then potentially they look at a higher target for the S&P through to next year, but obviously a hard landing, then we would go lower, 3,400 potentially before bouncing towards the end of next year. So different scenarios for Goldman in the S&P, but certainly a downgrade in their year-end target. Just bear with me 1 second. Just got a question in. Yes, not quite sure of the question there. Will the big companies stock continue the bear market this week? If you just mean that, really, you're meaning just the stock market indices, will that continue? Will this bear market continue this week? I'll just look at the technicals now, actually. So it's a good question, and hopefully that's what you mean. We always look at the weekly S&P to start off with. So this is the weekly, that's the monthly actually, but bear with me 1 second. So this is the weekly. If you just ignore these fib levels here, because I've drawn on some wider fib levels, which I think are important now for the S&P. You can see the breakdown. You saw last week, actually, we highlighted this great big red candle here. So that's a bearish engulfing candle. You see it engulfs the bullish candle that we saw the week before. The range is wider than that bullish price action from the 6th of September in that week. So that sort of signaled to us, along with that breakdown, through that trend line support there that you can see in the dotted line, that potentially we were looking at lower prices. That's obviously what we got last week. And you can see now on this weekly chart, the key levels now of support are obviously that June low at 36.36 we have. And then you have also the 200-week moving average. That's that dark black line at 3,585. And then even below that, we've got the halfway point. This is this small dotted line here, the halfway point of the move from the pandemic low up to the highs seen in January. The halfway point is just above 3,500. So sort of 3,500 major support. Then we have 3,585 and then obviously 36.36. And you can see on the daily, yes, just this breakdown below that trend line support there, sort of hanging around below there, around 3,900 or so, and then obviously the break lower after the Fed really, and into this key level, the key mid-June level of 36.36. Certainly bearish. We've had a few days, obviously, bearish momentum. That's continuing really, and then that sort of everyone is looking now at this mid-June level. And if we look at other markets as well. For example, the NASDAQ, we haven't quite reached there in the NASDAQ 100. This is just to remind you, just above 11,000, 11,037 is that mid-June low. So huge level of support potentially. If we look on the weekly, you can see actually we're touching really that black line there, which is 200-week moving average. That's at 11,158, and so just above that mid-June low. If we do break there, you can see the bearish descending channel we brought in there, and potentially then we go lower towards obviously below 11,000, and we're getting on to sort of levels probably around next support below 11,000 is probably 10,677 or so potentially. If I just pull up the Dow chart again, you can see a break of that 200-week moving average, 29,752 on the Dow. The daily, we have broken that mid-June June support actually at 29,653. So potentially we are then going lower. We look at levels then, probably big figure levels, unless we get, this August high, actually 29,199. Potentially, and then round numbers, so 29,000 potentially, if we do break lower below these key support levels, the mid-June levels, and the 200-week moving average we're looking at. I just said we'd look at the Dow, the DAX actually. We've highlighted that before actually as well. Key levels that we've highlighted around the sort of 12,400 level. That was the June low, 12,390. And then we had the March low at 12,438. We've broken now below there on the daily. I think probably the weekly close is key for that break lower. If we do move a lot lower, you can see there how important that support is. That's why we've highlighted it. And then probably the weekly close is key, but moving lower, obviously, Friday, and then today we're sort of hanging below that key support level, which now becomes resistance. I said also we'd look at some of the other assets. Gold for sure, interesting move lower on Friday. You can see we highlighted 1676, but before that, let's just talk about some of the fundamentals. Obviously in gold, hawkish Fed, of course, and then this continued rise in real rates. We mentioned that last week actually, and obviously then this surging US dollar seen gold fall obviously to lows. These lows actually today, I think the lowest since April 2020. Last week's drop was around 1.9%. Which is kind of relatively muted actually, given that 3% rally in the dollar and also that great big jump in US 10-year yields. But it's the real yields which are most significant for obviously gold, which is obviously non-yielding, and so real yields, that is, if you remember, those adjusted for inflation, they're now going towards 1.4%, I think now. So where they were negative, in negative territory from sort of March 2020 up until April this year, since April this year, really rocketed higher, and that's seen gold obviously turn lower. Just technically then, just to highlight some of the levels here, we had the August 2021 spike low at 1677. That's reinforced by the pandemic bottom actually at 1676. That's that dotted line there. You can see us sort of breaking below there a couple of weeks ago, and then sort of bearish consolidation, we call that really. We're consolidating around the lows before then this break lower. So we're still in this bearish channel as far as we can tell. You can see that, and potentially then we have to go back towards, I think the next level probably is around 1617, which is the 2020 high as key support. Let me just pull that up for you. Yeah, so 1617 actually is the halfway point between the 2018 low and the 2020 high, 2075. So the halfway mark of that is 1617. So that's what we have as next support for gold. You can see that break lower, the critical levels around the sort of 1676 level. That now becomes resistance. As I say, you've got the 200-week moving average as well at 1680 there, acting as further resistance, and then a potential move lower towards 1617, and then 1600 probably a round number. One other market I think worth highlighting is oil and Brent. Let's look at Brent, which is here. Just bear with me 1 second. You can see this fifth straight week we're now into losses. It's really sort of unrelenting pressure, if you like, on commodities, including crude, of course. The Friday especially was a very gloomy session, down over 5% or near 5% actually, accelerated by dollar strength and of course growth pessimism, if you like, really causing ripples through commodity markets. We've seen, continuation of that move lower after Friday's big 5% drop or so. Weakness through Asia, of course, and then even now today we're dropping towards sort of 84 or so. If we do drop sort of around, if you think further towards 80, then we may soon see OPEC plus action potentially try and support prices. Russia repeating its warning actually of not supplying commodities to nations that join any agreement to cap prices for its crude. And with the market increasingly priced in a recession, then yes, we might potentially get OPEC plus support and potentially looking at that around sort of the $80 mark. As I say, if we pull up the weekly chart, you can see 5 straight weeks of losses, lower highs and lower lows really there. So a bearish channel again, and not sort of potentially major support until that the light grey line is actually the 100-day moving average. So that's just above 80 there on the weekly, but certainly a break lower, looking gloomy for oil prices. Right, let's move on to sterling then, and let me just bear with me 1 second. We've got here a chart actually. I haven't had time to update it sadly, but this was Friday's price action actually. So just sort of highlighting what we saw last week really. The biggest one-day intraday move that was 3.5% down. Sterling was. We've not seen anything like that well, we obviously saw it during COVID. That's this move here. Then we've seen it obviously during COVID, and then during 3 other times, of course, being the GFC low, the 2008 low, Brexit, obviously 2016 was that major low then, or this intraday move, actually, I should say, this is. Then the 2008 GFC move, and then we go back all the way to 1992, actually, in Black Wednesday. So the move actually today, I think was down, we were down at 4.7% or so. So that would be probably the second worst intraday move, but we haven't obviously closed there, and we're looking stronger from that low. If we just look at cable, just bear with me 1 second. We can see, this is the daily chart, and that obviously that spike lowered down to 103.50. I have it before. Obviously now we're stabilizing above 107. This all comes, of course, after new UK Finance Minister Chancellor Kwasi Kwarteng announced this so-called mini budget. If you remember, mini budget really not being the correct word, included, these wide-ranging tax cuts. of approximately around 45 billion, but it added to the estimated cost of around 150 billion potentially for these fiscal measures in supporting energy prices and the energy plan. It was kind of all reminiscent of previous tax slashing moves by the same Conservative Party in the late 1980s, which boosted inflation. Really, instead of obviously stabilizing markets, the announcement of course sparked mayhem, really, it's got to be said, as it promised even more inflation at a time when the UK is obviously set to slide into potentially quite a crippling stagflationary recession as prices soar. I think crucially now, as we've entered into this sort of sterling crisis phase, it's typically, if we just think about this, it's typically looser, traditionally looser fiscal and tighter monetary policy, which is normally a positive mix for a currency. But that's only if you can fund it and you can confidently fund it, really. And that's the rub here. Investors have doubts about the UK's ability to fund this great big fiscal package. And now, of course, foreign investors are really have shied away over the last few weeks from UK debt due to the impact the plans will have on the UK's public finances. And certainly markets are losing confidence, have been losing confidence in the UK's economic management. I think really then three major issues, if you think about this in a wider scale, really it's then the bumper fiscal package, it's the rapidly widening current account deficit, and then this fast approaching recession, really. And that's really getting investors very worried, questioning their exposure to sterling assets. And in theory, well, the Bank of England can obviously stem outflows by raising interest rates, and there's a lot of clamour for that. We'll touch on that shortly. But it would obviously do so at the risk of then worsening two of those three problems I've just mentioned. And then there are obviously other concerns around political instability. I think I just saw a couple of tweets saying, obviously, the governing party at the moment, the Conservatives, are very nervous about the new Prime Minister and potentially even letters going in, just like we saw with Boris Johnson, of course, and talk about that. That just all creates political uncertainty, instability. And let's not forget, I think we're on our fifth Chancellor in just over 3 years. So really just add all that to the melting pot, the crisis really that is enveloping really sterling. And then also we get potentially ratings agency downgrades. I don't think the next update is due for a few weeks, but potentially that will be an issue for markets. What happens next then? Policy support, obviously, for the pound might come in the form of a government U-turn on fiscal policy. But that kind of seems unlikely at the moment after all the measures, of course, announced recently. And also then potentially more to come. Those of you who watch Sunday UK television may have noted Kwasi Kwarteng again, potentially talking about more fiscal measures, for more tax cuts to come. And that certainly worried markets in the Asian session. There is, of course, much clamour for some kind of statement now from the Bank of England about what's going on in markets, and also then an intraday rate hike, an intraday meeting that would be a rate hike. And we note actually since it gained independence in 1997, the Bank of England has never raised rates between scheduled meetings. But of course, these kind of moves in sterling, we've not seen for, decades really. Yes, I've just got another question actually in here. If you bear with me 1 second. Let me just come to that in a minute, because I'll talk about the Fed actually. So it's just a question about recession psychology actually. Will that continue to be a factor with fundamental analysis rather than technical analysis. So the technicals, I guess I was pointing to lower prices in stocks, but whether we see that fundamentally. Well, briefly, just to answer that actually then, it's obviously to do with central banks and the pivot that we saw, not the soft pivot, the dovish pivot, but this hard hawkish pivot, if you like, since Jackson Hole, since the end of August, and really central banks telling us they're going to concentrate on fighting inflation and really kind of disregard growth, disregard potentially a recession coming. And you will hear many commentators talking about a potential accident that may happen, or that may be the only way that the Fed then slows down. And I think that is a valid reason to give. Potentially the Fed has to cause some kind of accident, be it with unemployment, as I've said, which I'll touch upon actually in the new Fed forecasts, or some other accident which then slows the hiking cycle that the Fed is on. But at the moment, that is fairly concrete, and those are the fundamental reasons which are driving the dollar higher, driving bond yields higher, and then causing a potential recession as growth slows, which is, of course, their intention in a way by hiking interest rates in some sort of basic sense. Good. I'm glad that's answered the question. Any more questions, please keep them coming. But as for sterling, yeah, what happens next? We said about policy support potentially and a U-turn. I would add on that actually that the new Prime Minister does have form actually for U-turning on policy. If you remember, during the run-up to her victory in the election, leadership election, she initially did say she wouldn't be giving fiscal support for the energy cap and handing out fiscal support in that way. But obviously, she's kind of U-turned on that quite spectacularly. But that's not saying that will happen again soon. The other issue, there may be an announcement. This is slightly more technical, but potentially people have talked about an announcement from the Bank of England suspending their planned gilt sales in October. And certainly that would be welcomed by the gilt market, and then certainly then sterling as well. Gilts are UK government debt, and they continue to drop today after Friday's really massive sell-off. Really, I can't begin to explain how big that sell-off was. It was the worst day since the early 1990s. Prices obviously in fixed income, they go down, yields go up, and yields on gilts, on that 10-year gilt, which a lot of people are looking at, they pushed a lot higher, up above 4.1%. And that's from around below 3.5%. Just on Friday before the fiscal announcement by the UK finance minister. So an absolutely massive move in the UK gilt market. And that was where it sort of engendered fear in the market in sterling. We saw the massive sell-off then, and that sort of obviously continued in thin liquidity in Asian hours. One thing to note, actually, some people talking about FX intervention by the Bank of England, by the UK. I think we should note that the UK really does lack resources, unlike the Ministry of Finance in Japan. The UK lacks FX resources to intervene directly in markets. I think it has around $80 billion worth, which economists, I think, say is barely enough to cover 2 months worth of imports. So when there's lots of talk about FX intervention because of the Ministry of Finance in Japan, of course, last week, I think you can kind of take that off the table for the UK, and we're looking at other ways potentially of support. I'm just checking actually if there is any announcement. I don't think there is at the moment as we're talking, because cable's sort of pushing up here above 108 now, but nothing concrete that I can see, unless any of you guys can. Nothing concrete from the Bank of England, which is probably what most people are now looking for, some support, and why we've seen this pretty strong bounce actually from that spike low. Just looking at the chart, then you can see, I think it's quite interesting really now, whether we're at peak sterling fear, if you like. You can see on the weekly here, nice bearish descending channel, respected a couple of times, but then obviously now we've got this massive move lower, 103.50 the low. I think I've got, well, 103.56 on this price. You might have something similar, different, but then potentially quite a bullish candle, depends where we finish today, but a sort of strong rejection. We obviously crashed through previous lows, 105 before, and then let me just look at the mid 80s low. I think here was 105.45. Okay, and then obviously 103.50 or so around today. But you can see just on this bearish channel, if we pull that out, a real sort of tank, a spike well below that channel, and then we're pulling back into it. So potentially we have resistance around last week's low. That's at 108.34, which we're heading towards. So that'll act as first resistance really to this cable move higher. And then if we drop to the daily, that was Friday's move really. So we'd probably have to drop towards a shorter time frame to see any sort of initial points of resistance, as well to sort of look at if you're an intraday trader. But we've probably got the daily close 108.34 as key resistance, and then sort of big figures potentially wherever we've drawn that sort of bottom of that bearish channel, just below 110 potentially. That's for cable. I said we'd look at euro sterling actually. I think that's kind of slightly more interesting. You can see that spike higher there on the daily to spot 92.77 actually. We've pulled back below 90 now. But if we look on the monthly, you can see really when we get above 90 really, these sort of spikes generally that we've seen, that's the pandemic spike there really that we got to, well, nearly 95, spot 95, but anything above 90 really doesn't hold for that long. I know this is a monthly chart, but you can see then on a weekly, if we pull that back slightly, so above 90 or so, 91 even is quite rare, and we do pull back quite sharply, quite quickly below that. And obviously we've done that today potentially, and then on the daily you can see that massive spike, and then the massive move on Friday as well. So again, Friday's high probably a good level for support resistance. That's at 89.35. But then we go probably to these levels here that we oscillated just below, sort of around sort of 87.87 there, 87.83. So as potentially next support if we do push lower below that Friday high. Really amazing levels here in these sterling crosses. If you looked at some of the other crosses as well, sterling Swiss, massive move there. And when you get sort of 2-3% intraday moves in these pairs, then it's kind of getting towards these oversold, overbought levels. Okay, let's just look now at the Fed meeting from last week. Just to highlight really, you probably all followed that, but obviously key meeting for what's been happening. We've already answered that question around sort of fundamentals, looked at the technicals, but then the fundamental reason for this dollar push higher. Certainly the Fed meeting really kicked that off, if you like, last Wednesday. Kind of confirmed expectations. As I said, hawkish 75 basis point hike, taking Fed funds to 3 to 3.25%. But it was the projections really in the dot plot, which we'll get to here, but also the projections for slower growth, higher inflation, and then higher unemployment as well. And that was all down to this restrictive policy that we're seeing from the Fed. The FOMC, they effectively acknowledged that with these forecasts that a recession is coming, and inflation will not fall quickly. and there will be some pain, really. We note the unemployment rate for next year. I mentioned that just briefly. That's expected to reach 4.4% actually, versus the current 3.7%. I think economists, they equate to that being over 1 million jobs lost. So there's the pain for you potentially, and really unemployment, the levels above sort of 4%, 4.4%, they stay there potentially through to 2023, 2024 actually, with only a very minor drop in 2025. The statement itself, the Fed statement, that was an exact copy of the end of July actually. So just really ongoing increases in the policy rate will be appropriate as inflation remains elevated, we know, really reflecting supply and demand imbalances with higher food and energy prices and really broader price pressures. And we can see on this dot plot then that was key for the markets really, because you can see actually, we don't normally show you this, but it's worth showing because it was such a big change from the previous dot plot. If you remember, the dot plot is the expected midpoint of the Fed funds target range at year end. So these dot plots are each Fed official on the FOMC giving their expected midpoint of that range. And you can see really, it really does highlight how the FOMC believes it will need to tighten to achieve the objectives, bringing inflation, if you remember, back to target at 2%. The median participants' expectation of where Fed funds rate would end this year, so 2020, is 4.4%. It rose to 4.4% from 3.4% last time about. And that therefore really implies an additional 125 basis points of tightening in the next two meetings. So that's November and December, 75 basis points, I think is given around a 70%, 72% chance now, and then a 50 basis point hike in December. That's what's priced and by markets actually, just for this year. And you can see the dot plot of where Fed officials think is also pretty much around that level, 4.4%. And we saw big moves. The big moves were because these dot plots were more aggressive than what the market was thinking actually before. The dot plot, as I said, was 3.4%. We all expected that to move higher to around 4% or so, but 4.4% was certainly much higher than most analysts thought, most economists on Wall Street thought. And in addition to the faster pace of tightening in the near term, most FOMC participants, they saw the Fed funds rate staying high through 2023 and 2024. And you can see that on the dot plot, the median year-end estimates in 2023, 4.6% there, going a touch higher. That's the red line, before falling to sort of 3.9% in 2024. I think all but one participant saw the Fed funds rate finishing 2023 between 4.4 and 4.9%. Yep, you can see that sort of broad sort of consensus. And then we don't fall actually to 3.9% 2024. And if you remember, most markets, or the market really was anticipating cuts. And I'll probably just get to that shortly. I think it's interesting really when you get to 2024, you can see the cluster of dots really has extended, so it's spread out here. And that's sort of, we highlighted that actually in our daily commentary, if you read that on the website. Just this wider range of outcomes, wider range of estimates, with the lowest projection actually in 2024 around 2.6% or so. But then the highest 200 basis points higher at 4.6%. And that's really quite a concern, really, if you think that there's such a widespread potentially in where Fed officials think rates will go in a couple of years' time. So really that says to us that volatility will be extended for some time, really. I guess what is strange as well, that's a dot plot for now, so you can see the bump up. And really this chart I wanted to highlight just briefly, actually, if you like, it's where we've come from really. And it's kind of strange how long it took for investors really to believe Powell's message. We can see this is the Fed's implied rate actually on the February 2023 future. But you can see just this push from sort of 3% in June. And then obviously we had the summer rally in stocks, the potential or the hopeful pivot by the Fed to possibly be more dovish, so not hike as much. And then obviously sort of end of August, as I said, around Jackson Hole, then this push higher, very sharp push higher in Fed funds. Really in a matter of days, we sort of jumped from sort of 3.5% above, and we've pushed higher. And it also obviously got pushed higher. Sorry, just sort of checking out the chart, of course, by the CPI data, July's data, of course, and then August data as well, where we were obviously hoping for a print below, headline print below sort of 8%, and we sort of jumped up to 8.3%, as well as the core as well, moving above, quite substantially above 4%. So those inflation prints, obviously, plus Jackson Hole, really seeing sort of bond markets implying rates would go faster and stay higher for longer. Just briefly, we do have the Fed's favored inflation gauge released on Friday. That's the core PCE data. That's expected to rise 0.2 to 4.8%, I think, year on year. The monthly print's expected to rise as well. So price press is really still broad-based, but this chart, I actually put it in last week, if you remember, potentially the core PCE is potentially sort of drifting lower. That's the hope at the moment. Of course, if we do get that like core CPI, which moved higher, then that would be a real shock for markets. We'd probably get the terminal rate, which is above 4.5%, potentially moving to 5%, with that US 10-year Treasury yield that I showed you earlier, moving towards obviously the 4% level. We also get lots of Fed officials actually this week, I think into double figures of Fed officials potentially on the wires, and they could potentially confirm that big 75 basis point rate rise in November, and that should really underpin support for the dollar. Right, we'll just touch on the Bank of Japan if we can. We're going probably over time now. I normally like to keep it to 45 minutes, but as I said, there's so much happening, of course, in markets. The Bank of Japan, really the last man standing, maintained last week on Thursday, if you remember its meeting, maintained its ultra easy policy, kept the policy rate unchanged at negative 0.1%. We kind of have to remind ourselves where that policy is, negative 0.1%. The policy rate at the Bank of Japan, and it continues to defend the yield cap for its 10-year government bond. That's at 0.25% on that government 10-year government JGB, the Japanese government bond. The Bank of Japan also kept its forward guidance on keeping rates low or lower, and repeated its commitment not to hesitate to add easing if needed. Very dovish, still remaining dovish. One phrase we did pick out, actually several people have picked out, actually, is the Bank of Japan did say underlying inflationary pressures are building. But otherwise, well, the yen spiked lower actually after the outcome on dollar yen, and it temporarily moved above 145 actually for the first time since 1998. But then, of course, not long after that, we got the Ministry of Finance. They stepped in and intervened in dollar yen as it neared 146. As I say, 145.90, that high. And well, it was the central bank's first dollar selling operation since 1998. Officials said the moves came in response to sudden one-sided FX moves, and the dollar dropped around 5 yen in response. But obviously since has recovered over half that decline, actually. I'll just pull up the chart shortly, but just to show you here, dollar yen, yeah, around 145, pulling back on the intervention. And you can just see these diverging bond yields. I know many of you might not look obviously at bond yields previously, but obviously now with rates moving so much higher, it's really worth paying attention to the 10-year yields in these countries. And you can see the red line, US bond yields moving towards 4%, whilst the blue line, Japanese government bond yields, this is the 10-year, really still just above 0%. So that highlights really where we are, and that's what's been driving dollar yen. I did touch on last week, actually, that before the intervention, obviously, it had been a few tense weeks, actually. Bank of Japan officials, if you remember, had phoned currency traders on banking desks, trading desks to inquire about market conditions in a so-called rate check. And that really was the prelude to highlighting the government's sense of alarm around the yen's sharp fall against the dollar. But the issue is here is obviously, really, it's quite hard to see them being effective on a unilateral basis, as really history has taught us that when Japanese authorities go it alone, if you like, with intervention. So that's what, when we talk about unilateral basis, that's obviously just one central bank attempting to change price action, to change the yen direction, then that has historically really struggled and has really failed, actually, without sort of some more concrete intervention by other central banks. Obviously, the other issue is this gigantic split that you can see, and we've highlighted on this chart here, between obviously the hawkish Fed, if you like, and then moving up rates, and obviously then the dovish Bank of Japan. And just pulling up the dollar yen chart, you can see obviously this sort of that big move higher and then sharp move lower, and then we've sort of traded back into this range. We thought it would be sort of 140, 145 range, 145 being the line in the sand, but obviously now we're pulling back into the top of that range above 144 today, actually. Going forward, fundamentally, well, intervention, as we said, tough to sort of go against the market, really, and that's what you can see is happening now. Certainly, should the Bank of Japan scrap its policy, that yield curve control policy of capping 10-year JGB yields around 0.25%, potentially if it tweaks that, then certainly that paves the way for a big drop in dollar yen. And also energy prices have a big impact on dollar yen, as Japan, they're a major net importer of energy prices. That's had a big impact on their terms of trade, certainly, which has pushed dollar yen higher, obviously in yen weakness. So potentially, if we see even a sharper drop in energy prices, then potentially that might hold dollar yen. But at the moment, it's sort of, if we're looking at it on a technical basis, this is bullish consolidation, really. But we do have that line in the sand at 145 for Japanese authorities. 145.90 is that high. Above that, we do have, we've highlighted before, 147.67 being the high from August 98, I think it was. But until then, we watch out on the wires, of course, because of any signs of more intervention. Although, as we said, this is probably short-term in nature. Okay, I think that's all we have time for, really. Thanks so much for registering and tuning in. It's really a hectic time in markets for sure. So I would suggest keeping sort of positions pretty light if you're trading FX, of course. But there's certainly a lot of volatility out there to take advantage of. So good luck this week. Watch out for the wires, Fed speakers, potential intervention by Japan, by the Japanese authorities, and also then some sort of potential sign from the Bank of England as well to watch out for in sterling markets. Follow us on social media, and we look forward to speaking to you again same time next week.